Hello friends, in this video I'm going to discuss the adjusting entries with some examples. So there are 5 kinds of adjusting entries: prepaid assets, depreciation of plant and equipment assets, unearned revenue, accrued revenue, and accrued expenses. We are going to discuss each kind with an example. First kind of adjusting entry is prepaid assets. Prepaid assets are something that are recorded as assets initially. Some of the amount is used up by the end of the period, so the transfer of the part that is used up is made to the expense account. Some examples of the prepaid assets are office supplies, prepaid rent, prepaid insurance. Let's take an example of office supplies first. So the company purchased office supplies on January 1 for $5,000. By the end of the year, there are only $3,000 left into the inventory of the office supplies, which means that the supply worth of $2,000 is used up during the year of 2017. So let's do the T accounts for that. On the balance sheet, first we will look at the balance sheet. The balance sheet, there is an account called office supplies. So when we purchased the office supplies on January 1, we recorded $5,000 as our office supplies asset. And then when we are making adjusting entries at the end of the year, and we did the office supplies count, we found out that 2,000s were used. So we have to take out $2,000 from the office supplies account by crediting it, and we have to record the expense in the income statement, office supplies expense, and that is the adjustment entry that we will do on December 31, 2017. So credit the office supplies from balance sheet and debit the income statement account office supplies expense. Let's look at the second example for prepaid rent. Now let's say we as a company paid the rent for 3 years for a building that we are using. And so on January 1, we recorded $30,000 as our prepaid rent. So it was for 3 years, means every year the rent is $10,000. Now it is December 31, 2017, and we have used $10,000 worth of rent for 1 year. So we will credit the prepaid rent account from our balance sheet, and we will also record the rent expense on the income statement, and that will be done by the adjusting entry on December 31, 2017. So our entries are: on the income statement, debit rent expense for $10,000, and on the balance sheet, credit the $10,000 from the prepaid rent. Our third example is prepaid insurance. Same thing, we paid for the insurance for 3 years, and on January 1, 2017, and now it's December 31, 2017, and we have used the insurance for 1 year. So we paid $15,000 initially, which was for 3 years, and now 1 year has passed, so we will credit the balance sheet account prepaid insurance for $5,000 on December 31, and we will record the insurance expense for $5,000 on December 31. Now let's discuss the second kind of adjusting entries that are made at the end of the year. That is for the depreciation of plant and equipment assets. The company buys the equipment or the buildings and we record it at the historical cost. And in accounting, we are not allowed to make any changes to the historical costs of the property, plant, and equipment. Also note that the land is never depreciated. The property, plant, and equipment is recorded at historical cost. And as I have said that we are not allowed to reduce the historical cost of property, plant, and equipment. So we use the contra account to record the value of the asset that has been used up during the year. Let's take the example of depreciation. Our company has bought an equipment and that equipment costs us $500,000 when we bought it. The useful life of the equipment is 10 years and there is no salvage value. Salvage value is that after 10 years, will there be any value left over to that equipment? And in this case, there is no salvage value. We are going to use the straight line depreciation, which means that 500,000 divided by 10 years will give us the depreciation expense for each year. Now, if you look at the balance sheet side of this video, you will see that the equipment is recorded on January 1 for $500,000. And on December 31, still the equipment shows the value of $500,000 because we cannot directly go and reduce the amount of the equipment, the value of the equipment. For that, we use the contra account, in which all the depreciation that we do to this equipment during the years of life, we use the account called accumulated depreciation, in which all those depreciated amounts will be accumulated. Now let's say this is the first year and on December 31 we will depreciate the equipment. So 500,000 divided by 10 years of life gives us 50,000. So every year we will reduce 50,000. We will depreciate the equipment account for 50,000. So the entry is that instead of crediting the equipment account, we will credit the accumulated depreciation equipment account for 50,000, and we will, on the income statement side, we will record this entry as a depreciation expense for 50,000, and that is done by the adjustment on December 31, 2017. Also notice that the accumulated depreciation equipment account is not a liability account. It is a contra asset account which stays with the equipment on the asset side of the balance sheet. Now we will discuss the third kind of adjusting entry, that is unearned revenue. What is an unearned revenue? Unearned revenue is actually a liability account on the balance sheet. What does it mean? It means that the customer has paid us beforehand and the goods and the services will be delivered in the future. During the year, we have delivered portion of the goods and services, so we will recognize the revenue and reduce our liability. Let's look at the example of the unearned revenue. A gym membership for 2 years is received from the customer on January 1. Now this is something that the customer has paid us beforehand. We haven't delivered the services. The customer has not used the gym yet, but he is paying for 2 years in advance. So we will not record this as our revenue because we haven't earned it yet. We will record it as a liability on the balance sheet. Now at the end of the year, the customer has used the services of the gym for 1 year. So we will record the revenue at the end of the year for 1 year. If you look on the balance sheet side, you will see that the gym membership is recorded as an unearned on the liability side of the balance sheet, and initially the amount was $20,000. Now the whole year has passed and the customer has used the gym for 1 year, so we will reduce our liability for $10,000 and we will record the revenue earned on the gym membership, and we will record on the income statement the membership fees, or you can name it any way, but this is actually the revenue for the company, and the adjustment is done on December 31, 2017. Now let's discuss the fourth kind of adjusting entry, which is accrued revenue. What does the word accrued means? Accrued means outstanding or unpaid. If it's an accrued revenue, it means outstanding invoice or unpaid invoice. It means that we have provided the goods and services, but we haven't invoiced the customer yet. Now, in this case, we will initially record the account receivable and we will record the sales because we have earned the revenue and the customer has not paid us yet. So the entry for this is debit account receivable and credit sales. Now the adjusting entry for this is done. The account receivable account is actually updated throughout the year, but if at the end of the year during the last month, if we find that there are some customers to whom we have provided the services or delivered the goods but we haven't billed them yet, we will make the adjusting entry at the end of the year to record our sales, to update our sales records. The last adjusting entry is accrued expenses. What are accrued expenses? Now, accrued expenses are unpaid bills. Let's take the example of a utility bill. We have received the services from the telephone company, but we haven't paid them yet. So, even if we haven't paid them, we still have to record the expense. On the balance sheet side, we will record account payable, and on the income statement side, we will record the telephone expense. Let's say that during the month of December, we have used the telephone service for the month of December, but we haven't received the bill yet, and we will pay it in January once the bill is received. But that payment will be for December. If we don't record it, then we will not be going in accordance with the matching principle. We have to record the expenses in the period to match the revenues. So on December 31, we know that our telephone bill is going to be $500 for December. So we will record the accounts payable $500 and we will also record the expense for $500. Now, in all our examples, you have seen that the adjusting entries affect one balance sheet account and one income statement account. They are made at the end of the period. We will make, once we come up with the unadjusted trial balance, we will use the worksheet and we will make all the adjustments adjacent to the accounts. And once all the adjustments are made, we will match our debits and credits and see that the debits are equal to the credits. And then we will post those adjustments to the appropriate accounts to update the account balances. And after that, after the posting, we will get to the adjusted trial balance. Thanks for watching, and please keep looking up for my next videos. Thank you.